and welcome back to Financial Minds Meet the Experts. I'm your host, Jaime Agostino. On this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today, we're sitting with Vizo Financial's Executive Vice President and Chief Investment Officer, Fred Eisel, and Chief Credit Officer, Tim Sustak. Welcome back, Fred. Welcome back, Tim. Thank you so much for joining me today.
Thank you.
Jamie. Yeah, happy to be here.
All right, well, let's jump in. Tim, the Fed meets next week. Are we looking at a third consecutive 0.25% rate increase next week, or will the Fed hold?
No, Jamie, I think they're going to go 25 next week. For a number of reasons. Number one, if you've been listening to the Fed's trying to be pretty transparent about what it's going to do. And I think, they've pretty much told us that bar, no catastrophe, that, there's one more 25 basis point increase in the cards. And I think that'll certainly be at the May meeting. I think most probably expect that. And, I think we'll get there. And then I think with, everything out there, going on with banking industry, the fact we know that monetary policy works with a lag, the possible credit tightening, which can almost act like a bit of a rate increase. I think they will then stand pat and hold for a little while, let some of what's going on and what they've done work itself through the system, and then reassess where they're at. So I think we do get one more 25 increase at the May meeting, and then they'll take a look for a while and see how that kind of works its way through.
All right. Fred, do you agree with Tim this month?
Yeah, I typically don't like to agree with Tim on these calls, but I do agree with him on this one. Kind of teeing it up for a while here. The Fed has clearly slowed down to the 25 basis point trend, and I completely agree with Tim. March is pretty much in the cards here. And as a given, the market expects it. The market right now is pricing in about an 86% chance the Fed does that here in May. And not that the market was really on top of it. The market's been calling for the Fed to pivot and cut for a long time. The Fed, as Tim has mentioned, has been very clear and transparent that they're not cutting, not pivoting. They're going to continue to raise rates while the data remains hot. And the data is trending lower, trending better when you look at PPI, CPI, PCE, and some other inflationary numbers. The trend is much more improved, but those levels are still well above where the Fed wants them to be. So I agree completely with Tim. I think another 25 is here in the cards in May for sure. And then we'll kind of see what happens going forward.
Well, and to that point, so Fred, do you think this will be the Fed's final rate hike, or are we looking at another one yet?
In the camp that the Fed, and that's a good call. I think they're done here in May. I'm in the camp that the Fed is done and stays put. I am not in the camp that they pivot very quickly and cut rates. I think they're going to be here for a while. If they stay put and inflation starts to trend lower, I still think they stay firm. They don't cut and pivot anytime soon until it's very clear inflation's continuing to trend lower and inflation continues to get very close to their benchmark. And the benchmark's right around 2% PCE is kind of their measure. I think it's going to be very difficult to get to that number. But if they get to around, and right now it's above 4%, but if they get that number closer to 2.5%, below 3%, I think at that point they maybe start to look at pivoting and cutting. But I think the Fed does one more rate increase here in May, holds tight. But we got to look at the numbers. If the inflation data still remains elevated, unemployment rate remains low, claims data remains low, the economy looks okay with economic growth here in the first quarter, seems to be okay. If everything lines up that the economy is actually okay, not heading towards recession, and inflation still elevated well above the Fed's target, then the Fed could move one or two more times. They continue to say that it's data dependent. But I think, as Tim had mentioned earlier, with the banking challenges we've had here with Silicon Bank and some others, we know credit has already been tightening already. And the significant rate increases from last year has put pressure on the banking sector and on liquidity, which we can talk about later. There's a lot of pressure there, and the banking crisis that we've dealt with here in the last couple months has actually helped the Fed in a weird kind of way. With tightening of credit, that's actually tightening the economy. So that's actually helping the Fed. And so the Fed does want to kind of see where that lands and what that does to the consumer throughout the summer months. So I think they do one more in May and hold tight, and they're not close to a pivot. I think they hold tight in the summer. However, if data continues to be elevated, consumers in a good position, another 25 is not out of the question by any stretch.
Okay. All right. Well, you mentioned the word recession. So, Tim, many economists feel there are plenty of warning signs that the U.S. economy is headed for a recession. Do you agree? And what indicators are you basing that on?
Well, Jimmy, it's a good question. I'd be lying to you if I told you I knew for sure. Right? I don't think anybody does. But I mean, I think there are signs that people see out there that they point to. I mean, one of the more recent, the Conference Board's leading economic index for March came out at the lowest level since November 20th of 2020, I believe. So, that's one that you can point to say, hey, certainly pretending a downturn. The one a lot of folks always look at is the yield curve, right? The inverted yield curve, where shorter term rates are higher than longer term rates. And, that's generally been a predictor of recession, since I think back to somewhere around 1955. And, we're certainly in that environment, and that started last year. So, that's something a lot of folks look at and say, pretty good indicator that could happen. I mean, just anecdotally, you see more in the news about layoffs, things like that. And, certainly now we've got the debt ceiling crisis out there that is also putting some pressure. And, I certainly hope that we don't choose to do that to ourselves in default because Congress can't get an agreement done. But that would be certainly something that, and the closer that gets, without a resolution, the more nervous the markets are going to become. But on the flip side of that, you still have a jobs picture that's good. So, that's been the thought is, gee, it's hard to say we're in a recession or going to be in recession because we did have kind of the classic, 2 quarters of GDP in 22, back to back. That it's typically what people call a recession, although, the government gets to make that call through the National Bureau of Economic Research. And, they have not made that call that it was a recession. But, I think, you've said it's hard to think you're going to be in a recession with the jobs picture so strong. But, the Fed is searching for that soft landing, right? The ability to cool inflation without dipping us into recession. I think we've talked about this a little before. I don't think the Fed would be completely disappointed to see us go into a mild recession. That's certainly going to help get inflation back in check. I think, certainly nobody wants to dip us into a hard economic downturn, but a slight recession and, a mild recession, I think would help things on the inflation front. But, can they still engineer the soft landing? I think it's possible, but very difficult to do. And generally, unfortunately, not what happens.
All right. So, Fred, are there, Tim was talking about a few things. Are there any other indicators we or credit unions should be looking at right now? And if so, why?
And Jamie caught me on a good day because, again, I agree a lot of what Tim said. So this is a good day for the two of us to do this. Tim said it perfectly. I think it's the unemployment rate, initial jobs claims, which is a weekly number. And so as those start to increase, those feed into the monthly unemployment number. Claims they've been increasing and trending higher lately, but still extremely low. Unemployment rate extremely low. So that gives the Fed plenty of room to continue to tighten policy if they need to. As Tim mentioned, the yield curve is inverted. It kind of points to recession, but it's just a weird environment we're living in here post-pandemic. As I said earlier, the markets have been calling for the Fed to pivot since last year. Last fall, they were going to pivot. They're going to cut rates. We're heading into recession. And they kept fighting the Fed, which is what you don't want to do. And the Fed kept continue to tell the markets and everyone else, we're going to continue to raise rates until we have inflation under control. We don't want a repeat of 1980s. The market's finally on board with that, but still, again, you have this inverted yield curve because, again, there's this fear Fed's going to cut, going to pivot. As Tim mentioned, a soft landing, just kind of a dream for the Fed. They're not going to do it. That typically never happens. But you have this pandemic piece that's overhanging us that we've never dealt with. So you look at automobile sales. If you're looking to buy a car, still very hard to find supply. The supply chain is healing, not 100% healing, but the supply of cars very difficult to find still. Workers still very hard to find. So even though claims are increasing a little bit, you see it in the news where Meta and Google and others are laying off. A lot of that's a function of folks couldn't find workers for so long, and the credit unions that are listening have had to deal with this as well. A lot of these companies overhired and just kind of held on to employees because they knew finding new ones would be very difficult. Well, now they're starting to lay off those folks because the need for them is just not there. But what's going to happen is a lot of those folks that went to the FedExes and the Amazon out of the service sector and hospitality sector, where there's a lot of job openings, those folks may come back around. They may have worked at the hotel making $14 an hour, or the teller window at 14, $15 an hour, but could make $20 an hour at Amazon or UPS or FedEx moving a box or doing something else. And that's all those wage pressures really created inflation the last couple of years. That has slowed down. So the teller that you're now paying $20 an hour potentially instead of 12, next year it's not going to 25 or 30. That inflationary piece has slowed down. You're going to see inflation trends head lower. But some of these jobs are going to get backfilled with folks that are getting laid off from the Amazons and the FedExes and the UPSs because the box volume, the package volume is significantly lower than it used to be. So that shift of workers is going to come back around. You're seeing it if you go to a restaurant or hotel. The workers are kind of backfilling, and restaurants are more full today. It's not half empty because they can't find a bartender, chef, or a busser. They're better off than they were because those workers are coming back in. So, I mean, there's a whole lot of data you can look at. Everyone has their kind of their special ones they look at. But again, it goes back to unemployment rate. Initial jobless claims, which is a weekly number, is kind of a leading indicator that feeds into the monthly. PPI, CPI, and personal consumption expenditures, PCE. That's the Fed's favorite. As long as each month those keep creeping lower, that's the Fed's focus, is inflation. Are they going to have a soft landing, as Tim said? Probably not. Are we heading into recession? Probably. The Fed won't say that, but they actually do want our economic growth and our consumption to slow a little bit. In fact, there's a mild recession. That's fine for the Fed to kind of pull this inflation back down to where they want it. So inflation data is key. So I'd keep an eye on that. Unemployment data is key. As long as that still stays really low, the Fed's going to be right there ready to pull the trigger again with higher rates if they need to. So just the typical data that folks have probably been looking at for the last year, continue to focus on it because the Fed keeps saying it's data dependent. As I said earlier, the credit issue that we're dealing with now is going to help the Fed a little bit here, but it's all about inflation and employment. And as those things start to trend and improve trend, the Fed probably will stay on the sidelines and maybe cut and pivot if they need to latter part of this year.
All right. Well, let's talk about liquidity. We continue to hear how liquidity is tightening for many credit unions. Fred, what recommendations do you have for them, and how can they manage this environment?
Well, it's one of those things which we work on quite a bit with our members, is just continuing to stay focused on the balance sheet and the liquidity avenues you have in place and get everything set up and teed up for when you need it. Typically, credit unions don't do it until they need it. So things like having your line of credit reviewed by our lending staff. Some folks have not, some credit unions have not had their line of credit reviewed in many, many years, and could probably have an increase in their line of credit commensurate with their asset and capital growth. Sign up for issuing Simplicity through the primary financial Simply CD program, Simplicity, however you want to call it. Issuance is a huge piece of a liquidity puzzle for a credit union. Extremely easy to sign up and extremely easy to use and issue. Credit unions a lot of times will do their internal CD specials to their own memberships, and that's fine. But issuing through the Simplicity program allows the credit union to get institutional money and get liquidity very quickly. Very easy to sign up. Very easy to implement and start up. Again, do it now. Even if you don't need it, get those documents signed now and prepared of what kind of pricing that's going to be. It may shock you that you may have to do a 1-year CD at closer to 5%. Well, guess what? To retain some of your liquidity from your members, you're probably going to have to do the same type of thing at 12 or 15-month 5% CD, because your members are finding that elsewhere outside of your credit union. So Simplicity, loan participations, There are credit unions out there that aren't very tight with liquidity and are buying bonds that are continuing to have loan volume and fund those. So if you're extremely tight with liquidity, you could probably do a loan participation potentially. That trick there is if you priced your loans appropriately when you did the loans and originated them, what's that market value of that loan portfolio when you participated out? The challenge for a lot of credit unions has been pricing. They had a ton of auto loan growth last year, and a lot of that was because their pricing was well under market. They gained a lot of market share, which is great, but you may be sitting on a loan portfolio today that might be a little underwater versus where the market rates are at. So, uh, talk to your corporate account manager, myself, Scott, Tim, on what are the liquidity options we have at the corporate, which are plentiful. Get all those in place, set up. So when the time comes, you need to set that up and actually access liquidity. The hard part's over. The documentation, board resolutions, all that type of stuff is already done. And then pricing, making sure that you're looking at pricing, not only just your loan portfolio, but your cost of funds as regular as possible. I don't want to say you have to do it daily nowadays, but last year, given how rapid rates were increasing, hopefully your ALCO, your internal group, meeting weekly should be meeting quite a bit to really pay attention to where market pricing is at to make sure that everything's in line in your balance sheet as well.
All right. Well, and the Fed recently came out with their bank term funding program. So, Tim, can you tell me more about the program, and are you seeing credit unions utilizing the program?
Yeah, sure, Jamie. So, the Fed created a bank term funding program to kind of ride on the rails of the discount window operations. In response to the Silicon Valley bank failure, and realizing that the rapid run up in rates, has left securities portfolios with a lot of unrealized losses. The Fed has come to the rescue and said, look, we'll lend to you on eligible securities, and a lot of the eligible securities are the federal government securities that credit unions invest in. And the nice thing about the program is they'll lend based on current par value. So no market valuation, no haircut. You can borrow against the full par value with those bonds for a term up to 1 year. You can pay it off anytime. So, very favorable terms, and, a nice tool that the Fed has come up with and put out there to help, federally insured financial institutions, try and manage that liquidity risk and make sure that, they're able to serve their depositors. Are we seeing credit unions use it? Yeah. I mean, I've talked to a number of credit unions who are interested. We've had credit unions pledge collateral through us that use our safekeeping custody program. We've had a number of credit unions position collateral there. I know some of those credit unions have taken loans down. Some credit unions have talked to us about being their correspondent. So, we can act as the payments transfer. If a credit union doesn't have their own Fed account, we can be their intermediary there with the Fed for loan payments and advances, things like that. So yeah, we've talked to a number of credit unions, at one stage or another, that were interested in the program. So there should be no stigma attached to it by the regulator. The Fed has made it pretty clear. Look, it's a prudent liquidity tool. You won't be looked down upon by the regulators for using it. And we have seen some credit union interest. I think as we get into the summer months, where liquidity typically gets tighter for credit unions, we may see even more interest in that. But yeah, I think so far credit unions haven't been afraid to look at it and use it, so that's a good thing.
Good. Thank you. Fred, you kind of alluded to this earlier. Credit unions historically are typically, slower at moving their rates than banks. Has this or will this impact credit unions? Do you think this might be the cause in some of the tightening of their current liquidity positions?
It may not be specifically their cause at this point. I think the cause of tight liquidity is just we're in an environment where rates are higher and folks that are on a fixed income or savers are finally seeing that they can actually make money in cash. And that's not sitting at the credit union or bank or wherever at 0 point whatever in their money market account. If there's another bank, credit union, a Capital One or a SoFi, some fintech that's offering 4% in the money market account, well, that math actually starts to make sense for somebody that's saving, 4% on money in a money market account, or 5% for a 15-month CD versus 0.35, 25, 5%, 0.5 in their savings account, that actually makes a difference. We haven't had this situation since 2005, 6, 7, leading into the financial crisis. You come out of the crisis, the Fed drops rates to zero. It's been what, 14, 13, 14, 15 years of zero interest rates. The Fed tries to raise rates a little bit in 2017, 18, a little bit, had a cut rates a little bit into 19, and of course went back to zero during the pandemic. So it's been a very long time since we have one true business cycle. We had a small recession there when the pandemic hit. We shut down the economy. That was manufacturing recession. But if you look back, there's been no business cycle recession since 2009, since the financial crisis, and rates have been essentially zero the entire time. Now, fast forward through 2022, a very quick year and very quick rising rates. You can make money saving money now, and it's a huge deal. And we have not been in that environment right now. So what you saw in 2022, as I mentioned earlier, there was debate internally, and we had those discussions with credit unions where the CFO wanted to do 3-year investments in a callable at 3 or 4 or 5%, where the chief lending officer wanted to do car loans at 199, 299. And so what you saw last year was the banking sector raising their rates on the auto loan area, for example, to market, and the credit unions were just historically lag and a little more sticky, and so they captured a ton of auto lending last year, which is great. The challenge is, though, that number one, you've lent at the car values at their peak last year because of the auto sector and the demand there, but also well below market rates. So that will impair their liquidity going forward, as I mentioned earlier, for trying to sell some loans or do a participation. Most likely those will be underwater, given where they were originated last year. But what we're finding out here at the start of this year, talking to credit unions, the loan demand is still there, but their pricing is right at market or maybe slightly below. So that pricing is a lot better. So I don't think that may impact liquidity for some folks, but the auto loan is a short loan. It's not a mortgage loan. It's a different type of loan. It's a much shorter average life. The liquidity tightness you're seeing today is universal. It's a massive run up in rates, and one, two, we had a massive run up in deposits in 2020 when the pandemic started. We were all staying at home. We weren't traveling, going anywhere, saving all of our money. We had fiscal stimulus. We may have bought a lot of Amazon boxes coming to the house every day, but we didn't really spend a whole lot of money. As time has gone on in 2022, especially into 2023, travel has picked up, spending has picked up in restaurants. And so the consumer is just generally spending down their pent-up savings. So if you look at the savings rate for the consumer, is kind of at the trend pre-pandemic. Of course, went through the roof during the pandemic. And if you recall, savings went sky high, delinquencies and charge-offs were record lows. The consumer was in perfect position balance sheet wise. You look at the personal savings rate today, it's under trend because we're back to spending more. You see balances on credit cards up. The tapping into home equity lines is going up, even though it's a floating rate. Typically, people have a lot of equity in their home and they want to continue to spend and are more comfortable to spend. So you're seeing that go up as well. So the liquidity piece more has to do with the run up in rates and now the consumer shopping. And the shopping today is not myself going into a branch of a credit union and say, hey, Jamie, I got money in a savings account or money market account. What are your CD rates? And let's move some money around. There may be some members that come into the branch and do that. There may be some members like Tim may call, hey, Jamie, this is Tim. I want to check on your loan rate or your certificate rates and look at maybe investing some money. Nowadays, it's all right here on the phone. They're going to pick up the phone because if you recall, grandma and grandpa didn't like technology in 2018, 19. 2020, when everyone shut their branch down, they had to get very comfortable with electronic services. That was the only way to bank and use the credit union back in early part of the pandemic. So now grandma and grandpa are very comfortable in the iPad, iPhone, and moving money around. And if they see a deal out there on Capital One or some other fintech or another bank or credit union across the street that's offering a pretty good rate, it's a few click of the buttons to open that account and move money. So yes, you can look at your wire report every day. Yes, you can look at your activity in your branch or your traffic in your branch, but it may be a slow trickle out of liquidity. And that's what we're seeing is not the $1 million or $2 million wire from your big member that has a lot of money and shifting it back. It's the member that's sitting there and saying, hey, I got 25,000. I'm going to move that to a Capital One money market account making 4% because you're paying me, Jamie, 0.50. I'm going to move it back to a money market mutual fund. Those kind of went away post financial crisis. Those broke the buck and were gone. They're back. And if you look at the trend line of deposits going to money market mutual funds, back kind of to the market, to an E-Trade or Scott Trade or Edward Jones, those balances are going up as well. So deposits used to be easy because everyone was paying basically zero. People were scared of the market. People were scared of the banks. The fintechs weren't really in play. Everyone was just kind of sheltering their deposits in place. Today, with rates at a new normal, everything's back in play. Fintechs, banks, during the Silicon Valley Bank issue, a lot of folks were moving their deposits to Wells Fargo and JP Morgan and Bank of America, so they were bigger and seemed to be safer. And they were going to the money market mutual funds because they were out of the banking sector technically. So those deposit options are back, and they haven't been really an option for a very long time. So pricing is absolutely critical. And the liquidity piece has some to do with the pricing of the loans that they've done over the last couple of years, but a lot of it is the cost of funds and how to retain deposits now is a different game. It's kind of pre-financial crisis, and credit unions need to be aware of that and price effectively.
All right. Fred, any final advice for credit unions, out there trying to navigate this environment?
I would just continue to two things. One, pay attention to the markets and what the Fed says. I know the market, like I said, the market's been saying the Fed's going to pivot. The yield curve says we're going to recession and very well could be. But listen to what the Fed says, and they continue to say they're going to look at the data and they want to get inflation back down. So continue to listen to the Fed and watch the economic indicators we discussed. Unemployment, CPI, PPI, PCE, all the acronyms out there. Keep an eye on that, pay attention. But most importantly, at home, at your credit union, stay focused on pricing. Again, if you're ALCO or your internal group, whatever you call it, an internal ALCO or internal financial management group, whatever you want to call it internally, if you were meeting monthly, you may want to step that up and meet a lot more than monthly. I think the rage of higher rates last year's over. We're going, as we've talked here in this call, maybe 25 basis points a clip, but still rates are moving very quickly. And so just be very vigilant and pay attention to market rates and make sure your loan rates are competitive, but at market, but not too under. Make sure your cost of funds are at market. Now, it may take you time, because of costs and margin tightness to get your rates back up kind of near market. You don't want to chase the special rates out there, but be very aware that your members are now paying attention. That's going to continue through the summer months as we typically see tight liquidity anyway. Mm-hmm. Your members are paying attention and they're looking. And while they love you, the credit union, 0.50 versus 4.50, that's a different game today. We haven't had that game for a very long time. And that math makes a lot of sense for folks that are on a fixed income, the large baby boom population that's out there. They're going to move money because the rates are significantly different than they were for so long. So pay attention to pricing, try to stay at market as much as possible. And it's just going to be like this probably for the rest of this year. We've predicted here at the corporate very tight liquidity last year and most of 2023. We've seen it, and we project it's not going to get any better throughout the summer and fall, and probably into 2024 as rates probably most likely stay high. If the Fed does pivot cut, they're not cutting back to zero. A lot of folks in the market think, well, when the Fed cuts and we get back to recession, we're going back to zero again. Yeah, I don't see that. I think it may go back to 4% overnight versus 5.25%, or maybe 3% overnight. I think the days of zero interest rates are past us. And so just be very vigilant and very focused on pricing in the markets and where rates are at, where your competition's at, and make sure you're doing as much as you can to stay in line with that.
All right. Thank you. Tim, any final thoughts for our listeners today?
No, I think Fred said it really well. And I guess I'd just reiterate that, certainly pay attention to pricing. It might cost you some income to keep deposits, but a little downturn in income is certainly better than a liquidity issue, right? Liquidity issues are the worst things we can have as financial institutions. So certainly pay attention to your pricing there. Make sure you're working to keep your deposits. And, as Fred said as well, look at liquidity now. Try and get all the arrows in your quiver ahead of time. The best time to deal with liquidity is when you don't have a problem. It's always much more hectic and a challenge, when money's running out the door and you realize you've got to have it now, that's not the time to get the stuff in place. Get the stuff in place ahead of time, so you know what you've got to fight with.
All right. Thank you both so much. I just truly appreciate you taking the time to be here and join me today. I always enjoy our conversations and the discussion and the points that you give us. I really appreciate it. So thank you.
Well, you're
Thank you,
welcome.
Jamie.
Thank you.
All right. Today's episode is brought to you by Vizo Financial's FOMC video series. Inform, educate, entertain. Those are the goals of Vizo Financial had in mind when creating our different corporate video series. Credit unions are invited to watch all of our series to learn something new and maybe even laugh a little. We've got a series about Rodney May and all the shenanigans he gets into around the corporate, as well as a fun quarterly video about solving workplace issues featuring advice from our Chief Culture Officer, Joe Bertato, and his sidekick, Gene. We also have the FOMC update video series hosted by our very own Chief Credit Officer, Tim Sustak, where he provides an analysis of the Federal Open Market Committee meetings. And since the FOMC meeting is again next week, we'll have a new FOMC update ready on May 4th for your viewing pleasure. Again, thank you so much for joining us. And to access those videos, please visit the Vizo Financial website at www.vfccu.org to watch them at any time. As always, thank you and make it a great day.